Good morning. Good afternoon, ladies and gentlemen, and welcome to today's session. It's my pleasure to welcome you on behalf of the Venture Capital Matchmaking team to our masterclass today, focusing on how to master entrepreneurship. For today, we have two wonderful guests that we've invited along, Travis Buffy from Lingo Partners and Christian Kumar from Capital Kinetics. But before we give the floor over to these two wonderful speakers, just thought I would give a quick recap as to who we are and what it is that we do. So as a recap, PIT helps support companies entering into the UK market. With the VC matchmaking campaign, we actually do this with three key things. The first thing is actually on a bi-monthly basis is a brochure. As of June, this summer just gone, we had about 150 participants, companies who are actually featured in this brochure. The second element that we actually have are masterclasses such as this. We're delighted to have said that this being our fourth masterclass, to date we've had over 900 people registered to actually attend. And the final thing is we try and facilitate meetings between both companies and investors. And as of the summer, we had approximately 50 meetings that we facilitated. What does this all mean to you as a company or investor? Well, we actually helped approximately 20 companies come and land and fast track their entry into the UK. Now, of course, we don't do this alone. We do this with the wonderful help of our partners. And this brings me back to the wonderful introduction I'd like to do, or the wonderful speakers that we actually have today. So without further ado, I'll pass the mic over to both Christian and Travis to really take it from here. So welcome both.
Thank you very much. Now, see, I've roped Travis into this without preparing him too well. So we'll just, we'll ad-lib and go, but welcome everyone. Yeah. I think at the last count, there are about 149 people from, I counted up 11 different countries joining us for this hour. Elias said, can you keep it to an hour? And I thought, well, how do I take a 4-day session and cut it down to about 55 minutes? I'm not quite sure, but we'll go as we mean to. Right, so sort of the purpose of today is mastering entrepreneurship. So how does a company prepare itself for venture capitalists and investors? So next slide, please. So my name's Christian Kumar, as Elias just said. By background, I'm a mathematician and an investment banker. Today, I feel like I'm a business strategist, entrepreneur, investor, and a philanthropist. But I like to refer to myself as a growth hacker and a deal junkie. And in my business, I'm the chief troublemaker because I will always take on stuff that is beyond my capabilities, but I leave it to my team to deliver. So next slide, please. So just a little bit about what we're trying to achieve. Our mission is to empower entrepreneurs, developers, and scientists to be able to commercialize and advance their technology in their chosen field. Now, this could be in medtech, it could be in AI, it could be in various forms of technology that are either sustainable or innovate or create an easier life for others. And in a little while, we'll talk to Travis about what investors are looking for. What makes a deal great, and so I'll put him on the spot in a little while. But if we just go to the next slide very quickly and define the word entrepreneurship. So Merriam-Webster, everybody knows we're in Merriam-Webster. We rely on the meanings of words, but the bit that stood out the most in the word entrepreneurship was assumes risks of a business. Now, many entrepreneurs I know are the diametric opposite of that. They all want capital, they all want funding, but none of them want to assume the risk. But essentially, just by stepping away from their chosen fields, their backgrounds, is a risk on its own. They're willing to leave what they're doing to create a venture, and a venture that we hope will succeed. Now, the best way to learn these is to fail. So next slide, please. Now, everybody knows this young man, Mr. Churchill, or Prime Minister Churchill. Now, what I've learned over the past 12 years since I left my corporate life and becoming an entrepreneur is to be able to maintain a level of enthusiasm. So as Churchill said, stumbling from failure to failure with no loss of enthusiasm. My father always told me that a failure is only a failure if you didn't learn. Now, what we've got to do is go back and look at the history of failures. Now, if you come to Elias and I's workshop on the 24th, we'll talk about how large companies failed and then repackaged and succeeded in different sectors through the evolution of technology. And it's a very interesting sort of session within our workshop when what we try to do is create business plans from lessons of others. So next slide, please. Now, if I were to take all the lessons from all the investments I've seen, and I bet Travis agrees with me here as well, we get to a point of a tactical roadmap. Now, every entrepreneur lives and breathes this roadmap, whether they have it written down or not. The failure in a lot of businesses is when time moves away from delivery. And that means that an academic who is focused on academia, a researcher focused on research, engineering focused on engineering, often takes more time, spends more resources against a delivery of an end product. So the first thing as an entrepreneur is to make sure you present your tactical roadmap. Be very, very conscious of time when you're talking to a VC or when you're talking to an investor. Because if you have a fixed amount of investment that's to be deployed over a fixed period of time, and any one of those components delays, you could very easily find yourself on that slippery slide, also known as the Valley of Death. Why do we call it the Valley of Death? Because if you have to go back to that VC again for additional capital, it'll probably become the most expensive capital that you will ever receive. And this is not in the form of valuation, this is in the form of motivation. Because all of a sudden your VC is now concerned about the project. The additional equity that you might have to lose might demotivate you and your team. And all of a sudden, if you combine lots of little things, it turns into a bigger problem. So the one thing that everyone has to be very, very conscious of is staying on that survivability threshold. And the survivability threshold is making sure that you divide up your project and your delivery, the technology, into bite-sized chunks to make sure that the capital that you deploy in each phase of that development is accurate and on time. And time is the biggest killer of entrepreneurial ventures because things take too long. Today, we're seeing a completely different tangent in developing technology. We're seeing supply chains disrupting the way businesses move. We're seeing shortages in things like chips in the automotive sector. Lorry drivers in the UK we have a big issue around transportation. So, when we're looking at an entrepreneurial venture, when we're trying to present this to a group of investors, we want to make sure that we have looked at where we are in the current marketplace to make sure that we are able to deliver the underlying project or investment according to the timeline of the investor. Next slide, please. Now, I've added a little bit here. So a venture capitalist, an investor in companies or projects where there's a substantial element of risk. Just as we've said earlier, the entrepreneur takes on that risk. The venture capitalist is not there to absorb the risk. He's there to make a calculated decision. Now, what's happening in the world of venture capital? There's been many, many changes. In the old days, in the 80s, you would have these large venture capital firms that would create capital from investors, have a large pot of cash that they would then hire a team of investment analysts, researchers, and make educated investments. That world is changing, which leads me nicely onto the growth of the family office sector. So there's a movement of wealth. I mean, you're seeing trillion-dollar valuations now. You've seen Elon Musk, you've seen the likes of Jeff Bezos. And if you're on Twitter or social media, you'll see lots of funny comments that if Jeff Bezos gave everyone $1 billion, he would still have $193 billion spare. But that's not necessarily the way the economy works. That's not necessarily the way we heal everyone's problems. But what there has been is an increase in wealth and the movement of wealth from integrated venture capital to family offices. And I'll let Travis just talk about legal partners here in just a second. But it's that internal management of capital that is moving. Investments are now being made with more of a social conscience. And family offices now tend to club together as well as stand alone, which leads me nicely on to Travis, who is effectively the UK Director of Legal Partners. Now, had I have updated the slides, you'd see a lovely picture of Travis, but I'm going to let Travis introduce himself. Travis.
Yeah, Christian, thank you so much for having me, and a pleasure to be speaking with you all here today. Yes, I'm over here in London running I would say the European strategy for LIGO Partners, which is a multifamily office based in Miami. Essentially, what he's kind of talking about, the division of VC as it pertains to the new transition into the family office space is really unique. He kind of hinted towards it, saying that we can deploy capital with more of a social tangent. And I completely agree with that. But that boils down to one key difference between VC funds in the traditional manner and LP or and family offices today is that our LPs, our limited partners, or the people whose capital that we're managing, are largely more finite and much more direct in what their approach is. Whereas for a typical VC fund, there's on average about 100 different limited partners that the partners are managing the money on behalf of and deploying to create extra returns that are often in place for, say, something like a hurdle rate that they have to overachieve to actually get paid on. A family office can be more strategic and honestly can get involved earlier in the game and bear a little bit more of that entrepreneurial risk that he has touched on earlier. So it's not just the social angle, but we can be more direct and tactical with our deployments are, as opposed to a typical VC fund, which is spread across the gambling approach and then reap off the benefit of the winners. Oftentimes, our portfolios are much smaller, much more targeted around a certain sector. As it begins to transition, the capital starts moving into this private investment space as opposed to typical Silicon Valley-esque VC model. I expect that to really change the shape of the entrepreneurial game globally.
Perfect. Thank you, Travis. So next slide, please. So when we talk about presenting your entrepreneurial venture to a VC or a family office or even angel investors, what we teach in our workshop, and certainly we'll be teaching you this on the 24th, is something we call demand-based business modeling. The attention span of the investor that you're talking to is very, very short. I mean, if you talk to Travis or I, we're looking at hundreds of deals to get down to one or two. And it takes up a large amount of time and capacity to filter down. So what we've done is created something called demand-based business modeling based on some work that was done by the Stanford Research Institute back in the 80s and 90s. Effectively, an acronym was developed, NABC. So if I'm presenting my client's business, the first thing I want to talk about is the need. Because if I talk about the need, then I've addressed the size of the market. So I've already told my investor that, hey, listen, there's a need here, and this is the size of the need, and this is the need that we're addressing. Very quickly, you move into then approach. An approach, you get to talk about your company now. You get to talk about your technology, your development. What have you developed and your approach to addressing the need? So if you think of the frame of the mind, the investor now is looking at, right, there's an absolute need here in the marketplace. I've just been told how large that need is and the size of it. And all of a sudden, here's Mr. Entrepreneur, who's told me he's resolving this need by his clever approach. Now, it's just not important to know how something works, but it's also important to know why it does. So let's not get, sorry, I did that completely backwards. It's why we're creating technology, not how it's created. And refocus that approach on the benefits to the stakeholders. How does it benefit the users of that product or service or engineering technology? How does it benefit now, wider days, the environment, social impact? And then finally, you move into the C. You've got the N, the approach, the benefit is now the competition. Where do you sit on that competitive landscape? And often I say, what's unique about your company? And the stock answer is, well, nobody else is doing this. That's not the right answer. Sometimes the biggest competition to change is apathy. And unless we address the apathy, then we can't move further forward with that approach. So when we come to the workshops, we talk about, presenting the need, the approach, the benefit, laying out the competition. Next slide, please. And we break it down further into the market, break down the NABC into further modules. So again, we talk about the customer, the market, generally the size. A good pitch is 5 minutes. So if you think that you've got 5 or 6 salient points to get across, so you talk about the user, the market, and then the uniqueness and how it differs to the existing methods, the benefits to the stakeholder in the industry, and finally, making sure you watch apathy. So often you can create a solution to a problem that doesn't exist. So next slide, please. So when you're conceptualizing your idea, when you're creating that entrepreneurial approach, when you're developing your innovation, start with a different version of the model, the business model canvas. Start with, what need am I addressing? Why am I doing this? Not necessarily how I'm doing it. Creating the value. So what's the value proposition to the users? Who are the beneficiaries? And then build and mold your innovation to suit. So then when the investor's looking in, he understands the entirety of the business rather than the benefit of or the uniqueness of the technology underneath. And when you write the business plan, next slide, please, it's being conscious of who you're writing the business plan for. Sorry, next slide, please. Remember your audience, right? So the long and old days of an investment memorandum or a 45-page business plan has changed. Today, we have a short period of time to absorb a large amount of information. Now, if you're Travis and you've got 20 companies coming to you this week, he wants to see that information in a summary format that allows him to make an effective decision to take the conversation on further forward. Things like data, white papers, how technology works, research, will all happen in due diligence. It doesn't have to be in that front-end business plan. It has to be impactful, it has to be summary, and it has to be non-misleading. And what I mean by that is make sure you check your facts. Because if you don't, and somebody else does, the most embarrassing thing for you in the world is to present your business plan to myself, to Travis, to a VC, and they know slightly more about your sector than you do. Now, nobody says that you have to know it all, but whatever information you put out there, your content, is make sure it's been validated and fact-checked. Because often you'll find that if a VC family office is interested, they will have done some background. They will especially done some background on you, your product, and the market. Make sure that the funding doesn't just come from social sources. Make sure that you're not reliant, sorry, next slide, please. Make sure that you understand the various types of funding and funding structures. Because all I see and hear often from technologists is, I'm not giving up 50.1% of my company. This is when valuation should be taken off the table. You've got the other school of thought that says, well, I am, therefore you will. So if you're Welsh, you're expecting Welsh government to give you a grant. If you apply to the European Commission, well, I'm in Europe, so therefore I should apply to the European Commission. They should give me a grant. It's not that easy. In a world where we've become lazy in our fundraising, we've got to be that much more educated about where the capital sits. When are grants not enough? How do you assess equity? Now, if you go back to the technical roadmap, we talked about the various phases. So there's lots of stages in funding. There's pre-seed, seed, pre-A, A, B, and before you know it, you're in the alphabet of funding requirements. The only thing that happens in the alphabet of funding is the equity that the stakeholder has starts to dilute week, round after week, round. So when you're thinking about your business plan, let the investors know at the outset that I'm here to talk about the development of my project. Let's take valuation off the question. Let's talk about things like convertible loan notes. What is a convertible loan note? It's the ability to delay the valuation of a business. So it's a loan until the product hits the market, allowing the note holders to then have a discount to the market value at a point in the future. What are option agreements? Option agreements are a variable document that allows me as a scientist to be able to give you, the investor, if you're the investor, whatever equity you want. And you say, well, why would you do that? Because my option agreement says that if I hit those target milestones in my tactical roadmap, I have the ability to claw back that capital. Which brings me nicely onto how much. Everything will cost twice as much, and inevitably it will take twice as long. Make sure you're not underfunded. Make sure that you understand how much capital you need, what are the phases in your development, and how long it will take you to get to that revenue generation point. And what the investor wants to know is what's in it for him. So have a really good think about how you present what's in it for the investor, right? So I'm throwing little bits of information in lots of different modules that we would normally have. But, being sort of conscious of the time that we have and wanting to really open up the floor to questions. Sorry, next slide, please. I want to go through lots of bits in a very summary form. So again, what does Travis want to hear as an investor? He wants to know your development plan. How much of the venture is left into the project in proportion to the capital being invested? So a question that's often asked is, well, how much money has gone in? Where are you in your go-to-market strategy? How long before you start generating revenue? Have you envisaged another round of funding, especially in the world of medical tech? We will fund up to a clinical trial. We will conduct a clinical trial, then we'll fund beyond a clinical trial. And these rounds are very important for the VC to understand at the very outset. Because if he's an early stage VC or an early stage family office, they're not wanting to see a substantial dilution in the next round. And when we talk about the innovation, we also want to talk about intellectual property. What are the barriers to entry? It's not good enough that you're the only player in the market. What's important is that you've created barriers so somebody else doesn't have a leap into replacing your technology. And this is a funny little story I've had where a guy, he came into an event at the Wolf Summit where I was a panel judge. He valued his business at 10 million pounds as a startup. And I was just curious to see how he would answer the question answer the comment that I was about to make. And I said to him very cleverly, I said, well, if you value your business at 10 million and I have 10 million pounds today, how long before I can replace what you have? And that brings home valuation. It brings home your barriers to entry. If you value your technology at a certain size and you believe that you have the right route to market, remember, a big VC, a large family office, If they have that much capital and your idea is that brilliant, how quickly can they replace what you have? And this is why the intellectual property is so important, especially when it comes to technology. And if it's not the intellectual property, then what are the barriers to entry? Sometimes a patent isn't the intellectual property. Sometimes it's the corporate know-how, it's the engineering, it's the formula in a particular process that creates the barrier to entry. And whilst everybody wants to know the basis in which an investment is being made, try to take valuation off the table. Try to understand from the VC, what do they want? And then negotiate your key element of clawing back that equity. A VC will have a target return on investment in mind. He'll have a target return or a target point at which he will want to exit his investment out. Ask those questions. Because certainly if you do, you will put the VC on his back feet. And certainly we want to train you to do that. Not that I'm working against Travis, because Travis and I are friends, but you know, it's being prepared. It's being prepared. Not only is the VC understanding your needs, but you need to understand the needs of the investor. And when it comes to financial projections, next slide, please. Keep it simple. There should only ever be one financial model. Nobody wants to see best case, worst case, median case. All that tells me is that you haven't put enough thought into it. You need to have one model. Keep your sensitivities accurate. You know, the worst thing in the world is seeing a linear growth model. So I don't know if there are any accountants out there, and I'm going to offend you, and I apologize for that in advance. But you go to an accountant because they'll tell you where you've been. I go to my accountant at the end of each year and they mop up the mess that I've made. When it comes to financial projections, many accountants are not the right source. And the minutiae in the detail of your assumptions, the sensitivities, makes a good financial model and a bad financial model. For example, you're ready to launch, you're in your projections, you got your first 12 months of trading, and you put £10,000 a month for 12 months, 120,000 pounds of revenue in the first year. But that's not necessarily how it works, because nothing is linear. Often there are delays in cash flow because you might sell your product today and not get paid for 90 days. The product may have a fault, so you have to replace the product. So understand the sensitivities that go into your financial projections. Spend quite a bit of time understanding the sensitivities and making sure that the numbers that you present are accurate and well thought out. Also think about the return on investment. People say, well, Christian, how do you value a startup? You can't value a startup, they say. And I say, well, I can, Travis can, because as investors, we know that we want a certain return for our income. So if your year 3 earnings don't equate to the amount of return I want in year 3, according to the percentage of your company I own. So if I want 10% year on year for my £100,000 investment, I want to see a minimum of £30,000 or £300,000 in your earnings of your financial projections, because that's the return I want for the 10% of the equity that I own. Now, you know, some of you are thinking, well, hold on, Christian, that's a lot of information you're throwing out in a very short period of time. And certainly I'm more than happy to address some of these questions as we go on. The final thing, cash is king, right? Cash flow is so important. Cash flow can kill a business. So make sure you're well funded. Make sure you've thought out where you're spending, and also be very mindful that the cash that you're expecting to come in from trading may be delayed. The investment rounds that you have, the cash that comes in from the investment rounds, have to sustain you for your spend and any delays in your spend. And finally, there's a term that we've often used called break even. And I want you guys to think about that for a minute. Nobody wakes up in the morning. No entrepreneur wakes up in the morning and says, you know what, today I'm going to go out there and I'm going to break even. No investor wants to hear about your break even. What an investor wants to hear is a term that I've coined called cash collection. And what I mean by that is the point at which the cash flow spins off enough margin, enough earnings, so the business becomes self-sustaining. No matter the number of rounds, the alphabet of funding rounds, what I want to know is, when do you believe, Mr. Entrepreneur, that you will no longer need any more capital? And why is that important? Not because I don't want to give you any more money. It's that I don't want to see any more rounds of funding, because each round of funding needs another deployment of equity. So these are the key elements that we want to see in a business plan. We've talked about the need, the approach, the benefit, the competition. We know what the VCs and the investors want to hear. And now, how do you create that perfect pitch? Next slide, please. Right. For me, a perfect pitch is 5 minutes, right? But rehearse it. Rehearse it. Rehearse the attention span of your audience. If you're at a networking event, 1 minute's enough. You know why? Because the guy on the other side of that conversation wants to go get another drink at the bar. He also wants to network and meet other entrepreneurs. Don't monopolize the time if you're at a network event. Once you've got their attention, then 3 minutes. If they're really interested, 3 minutes is enough. And if you're presenting either through Zoom or at a meeting, you want to get to the point of discussion as quickly as possible, like I'm trying to get to today. So any more than 5 minutes is death by PowerPoint, right? 5 minutes is absolute perfection. In 5 minutes, you should have been able to cover your need, your approach, your benefit, your competition, your tactical roadmap, how much money you need, and what's in it for the investor. And those 7 elements are the 7 elements that create the perfect platform for an investor to say, right, I'm ready to take that to the next level. What is the next level? That's when you go back onto your research. It's that white paper. It's the support of the data. You get into the longer end of the information that an investor wants to see. So keep your presentation short, keep your financial summaries easy to understand. And when you are at the pitch, next slide, please. The main things to cover off: who are you? What do you do? How do you do it? And why you? And finally, what's in it for me, and what if something goes wrong? Right? And these are, again, these are some of the key elements. And I'm going to open the floor up to questions in a minute, because I think I went on a little bit longer than I wanted to. What I really want to do, there's over 100 of you out there, and I don't want you to be shy. I want you to engage in a conversation with both Travis and I, and ask those questions. There is no such thing as a stupid question. So if we go to the next slide, on the 24th of November, we're going to have a longer workshop, and it's developing the playbook, the perfect pitch, asking for money, the minutiae of investments. And certainly we will send that invitation out in a short period of time. And then my last slide is just me. I'm Christian Kumar. I had 2 jobs in my life. My first job was at Merrill Lynch. I spent 13 years writing derivatives and creating fixed income investments. I then spent 8 years building a wealth management business from a standing start to £4.5 billion. And we sold that in March of 2008. And for the investment bankers in the room, a significant time. No, I didn't predict the credit crunch. It was just dumb luck on my side. But what we learned was how to scale a business. From 2008 to 2021, we have invested in a number of sectors, from software, construction, renewable energy. Our main focus today is medical technology, and I'm a self-proclaimed deal junkie. So that's my presentation, guys, and really I'm looking forward to some questions.
Kristen, before we jump into
Absolutely
questions, would
excellent.
you mind if I
Yep, go on,
say something
Travis.
real quick? Just one quick, first off, thank you again, Christian, great presentation. I hope everyone's taking notes because that was some of the best advice I've ever gotten. I have a whole page full of them and I'm not even an entrepreneur right now. But I wanted to break down one last point that you made around the pitch. So 5-minute pitch, very concise. I actually encourage some entrepreneurs, and I don't want to go against anything that's being taught or anything, schedule the 15-minute meetings. Oftentimes you don't need any longer than that. It's going to be a lot of getting to know you, small talk. That can all come in later on diligence meetings. But when you break down your pitch to be as compact and concise as possible, that's amazing. But make sure there's a key aspect to the next is that follow up, that diligence process will come internally from the data room. And if that data room is sharp, concise, and easily to be distributed immediately after a meeting, you will save the entrepreneur or the investor so much time, save you from answering the same redundant questions over and over again, and also allow for that process of the interest developed from the investor to be facilitated much quicker. So I encourage just what he said, a 5-minute pitch is more than enough time to go over the key questions that will tell me if I'm going to dive in deeper, but then also make sure you have that background information ready to be sent to my inbox if I am ready to take that next step, because trust me, that will impress a lot of people in the investment space. But all around great presentation. Just wanted to add that before we go off track.
Perfect. Thank you.
Brilliant, brilliant, both of you. Thank you so much. You're talking about your page of notes. I've been sitting here scribbling away myself. Absolutely brilliant. So what I'll do is I'll start reading out a number of the different questions, just because the majority of them have been fired towards me. So I'm just going to kick it off, and feel free, whichever one of you want to pick this up. Is the first one that I've seen through is how does this approach differ across different sectors, part A, and then across different countries? Because again, there are a number of differences. I know very top level, fantastic, but we've got an audience, everyone from fintechs to medtechs and everything in between, and across a wide geography. So how does this really differ?
I'll answer some of that, and I'll let Travis give me his view as well. A lot of the presentation depends on who the investor is. So if you've got a family office deep rooted in medical tech run by a series of surgeons, your presentation is going to be slightly different. If you're talking to a group of angel investors, it'll be a much more simplified presentation. But if you stay with the core of the demand-based business model and then adjust the content to fit the audience, Travis, your thoughts?
No, completely agree. Also, as an entrepreneur, you need to be mindful of maybe not your domestic strategy, but also your go-to-market strategy, and as that pertains to year 1, year 2, year 3, and how that reflects the internal sales cycle that you'll be speaking on. So, for instance, a medical device company in the UK has a far different sales cycle than a privatized healthcare startup in the US. Therefore, you're going to see a lot more, especially out in the US, scraping for cash much earlier, whereas you can be a bit more patient in different markets, and that should be reflected in your own pitch as well as your own business plan. But you see that across, be understanding of the market and how that changes. And largely, if you're speaking with a global investor or a regionally specific investor, they'll understand that and appreciate your applicability.
Brilliant, brilliant. Thank you for that. The next thing here is obviously we've got two different types of investors here. We've got a family office and more of the traditional sense. Questions come in, what do the different paths actually look like? And we can start to break things down into the sweet spot, into when to actually raise. And then things get very complicated very quickly in terms of this as a question. But I think we'll leave it there as a top level thing, and we can start drilling down as necessary.
Elias, was that when do you start raising funding? Was that, yeah. So every investor has a different attitude to finance, and Travis is going to be much better placed to answer this. But for me, for medical tech, we are looking for something that's post-concept. So an idea has been well thought out and an approach has been derived. It doesn't necessarily have to be completely clinically tested, IPs filed, and a commercial pricing model, because as an early stage investor, I'll provide some of that value to the company. So in my world, it's post-concept and pre-revenue is a perfect time to raise money. And Travis has got a lot more experience with different types of family offices who have different views. Travis?
Yeah, absolutely. Sorry, I got the sirens in the background, so hopefully that doesn't dilute my answer. But no, it is very sector specific and also investor specific. As he mentioned, if you have a bit more industry knowledge going into an investment, you're able to, one, add more value to that deployment as opposed to sitting on a cap table and trying to wait for the next shareholder meeting. So that if you're saying I'm more familiar, like I said, a medical device based family office, I would want to get in earlier involved, even sometimes pre-concept, and I can help you develop it, get my hands dirty. Let's say in a general sense, I think you should only start raising once your IP is protected. And at that point, that means a multitude of different things. You can either have enough money in your back pocket to protect yourself legally, you're passing the business formation status, or even if you're before that, understand who you're pitching to get to that stage. So if you're talking to earlier stage investors, say angels, you can be a little bit earlier, I'd say earlier on in the thought process. But if you're going to a VC, you need to make sure your IP is protected because it is a very ruthless world, and not to scare anyone off, but the second we hear something like that, and we understand that there's not as many, I guess, screws into the house, we can easily go find an accelerator that we're funding already to go build it out. So make sure you're protected. I'd say that's at least step one when realizing you should raise capital.
Brilliant, brilliant. Another question that I see that's come in from this side is, from my side, I've thought, especially some of the earlier stage companies that are really putting their foot into the water into the UK. I always bang on about EIS and SEIS, and obviously there's a little bit of vested interest in there, given that we're trying to bring companies over into the UK and get them set up. But I thought, and maybe it's just worth coming back and hearing your opinion on it, and not a biased opinion from myself. What are your thoughts on it and the like? And hopefully you're going to give me the answer that I like or want to hear.
I mean, if you look at investments globally, I mean, you've got China and the US hitting the top of that tree as far as capital invested and projects that are deployed. For me, in the UK, we offer something slightly different. Not only are we a hub for capital in Europe, but when you look at the VC market globally, for a country of our size, we punch way above our weight. And if you combine why we're a better jurisdiction or a better home for entrepreneurial ventures, it's that combination of investment expertise, corporate growth, and the absolute plethora of engineering, business support, academics that are available in the UK at an entrepreneur's fingertips.
Absolutely. One of the things I think just more applicable, like I guess transitioning to back what your question was asking directly, I think anytime you can incentivize someone to move earlier on in that, earlier on in the business model, it is serendipitous to both investor and entrepreneur. It doesn't necessarily mean it's a risk-free scheme, but it gives you the opportunity to, I guess, say play a different sport. Which is early stage investing is a completely different game, and oftentimes it is more of a scattered approach, or you're very, very industry specific. But SEIS and those EIS initiatives really allowed me to be more broad with my my approach, at least for industries I'm not as familiar with. I'm a little bit more protected, at least on the front end with that deployment. So kudos to the people putting that on, and we don't have any any of those deployments in our own portfolio, but I'm very familiar with kind of the implications they have globally, at that matter.
Oh, brilliant, brilliant. So you did give the model answers. Well done, guys. Just as a bit of a follow-up then, in terms of that, a question for myself then is, how do you actually look at the support that we give to companies? Do you look quite more favorable, or leaving it quite open? Sorry.
The support as in from the DIT and the embassies?
Absolutely.
I mean, the DIT alongside the Global Entrepreneur Program is actually phenomenal, right? Because in the last 18 months, we've made 6 investments, of which 3 are born out of DIT events, right? So we know that the VC matchmaking, the educational programs that are proposed and presented by the DIT work. Because it wasn't that long ago that I was in Prague at the British Embassy there, and it was just 6 companies. But the little takeaway I left the 6 companies is, you know what? I'm more than happy to help any one of you develop your business plan and pitch. And all 6 of them followed up, which was a rod for my own back. But one of them we've just now introduced to the Global Entrepreneur Program. There's another one that's in the renewable energy space that we're looking at as a potential investment. So I think the DIT and the embassies across the world have their pulse on the local market. And that's the market that we wouldn't, Travis and I wouldn't be able to access without your support. So for me, having the opportunity to attend events like this, do workshops at the various embassies around Europe and around the world, allows us to cheat a little bit. It allows us to get in front of core companies in particular sectors that we would never be able to do on our own.
Completely agree. Anytime, and also even internally when there are opportunities, the blurbs and the white papers you put out detailing X amount of companies at different stages in different sectors every week is I think paramount to exposing us to this global network that you all have built, and the support that is oftentimes comes with a cost to a lot of entrepreneurs abroad. Much more favorable to you working with the DIT, and utilizing your service I think is a must, especially for domestic and abroad entrepreneurs that have the access to it.
Brilliant. Thank you both for that nice model answer. A quick question then to follow up, an interesting one that's come through. I know that you covered those 7 key elements within, but which one out of your experiences, and this could be 2 completely different sides, is the most common area that you really see companies slip up?
Right, I'll answer it, and I think Travis may have a similar or different answer. For me, it's need. The world is full of amazing technology, and you'll find competing technologies being developed in different countries, different parts of the world. But also what you see is a plethora of technology that has no place in the market. So for me, it's it's preventing people from creating solutions to problems that don't exist. So for me, if you can address the need and have a solution, you're more than halfway there.
Yeah, and it's great to fund. It's great to fund the early thinkers, the early movers to solve problems that do not yet exist. However, that is that is kind of, we could save that for a certain asset class of these types of investors, just because it's not something that's very commonplace. I would agree that need is the thing that people, need specifically, and need takes two different methods. What are they trying to build, and what are they trying to solve? I think oftentimes is too broad. In reality, you're not going. Most people, I don't mean to shoot and drink, you're not going to build the next global Uber. You need to understand where that traction is and what market you're trying to solve initially. And if you scale out into a global ecosystem of billions and billions of people and billions of users, well, great on you. But you should raise to fight your initial progress, your initial part of your business plan, so you can prove that you can utilize the capital that's coming in more effectively and more efficiently. And that efficiency actually is another thing that I wanted to touch on. Is oftentimes I see entrepreneurs raising too much. They're trying to chase the valuation game, and they want to hike up their own company, but that means nothing. All you're doing is diluting yourself out more. And this opposition to debt that I've seen a lot of people have in these past 2 years is another thing that's blown my mind. But again, I don't mean to get too much into the weeds of financially engineering your own pitch deck or your own cap table. But understand there's other options out there as opposed to just chasing the valuation game, diluting yourself out to try and take on this global dreaming strategy, which I do respect. Understand what the roadmap is and the KPIs along the way, and raise to reach that KPI. And of course, you can raise past it, but segment down your business plan for each round. Understand what you're actually trying to get out of this raise.
Brilliant. Thank you guys, both for that. I will encourage you again, everyone in the audience, please feel free to send through the questions. I'm rattling through them as quickly as possible, but anything that we don't cover today, we will follow up with afterwards. With that, then I have got another one that came in quite interesting about the target return on investment and that actual discussion of being, turning the tables around with investors. I thought it was a really, really brilliant point that you made there, Christian. But okay, so if I'm an investor or if I'm a company and an investor, yeah, is asking, we talked about the returns and the like. What are the core things that I should be asking? And that goes out to you as well, Travis. I mean, what sort of things are you going to start lighting up as soon as you start hearing from the company?
Travis, you want to go first?
Oh, please, we can't break the pattern. Go for it, Christian.
All right. We not only do we do workshops for entrepreneurs, but we also do the same workshops for investors, especially those that are very small or single family offices and those that are angel investors. And what you'll find is that the conversation is very similar. So the way we teach the entrepreneur to present his business are the same core elements that the investor should be looking for, right? Is, well, does that scientist have the right route to market? Is it the right product? Have they looked at the need? More importantly, the first thing that every investor should ask themselves is, do I understand this business? Don't get into blockchain if you don't understand blockchain. Don't get into crypto if you don't understand crypto, right? Make sure that you understand the investment and have a reasonably good understanding of the the entrepreneur.
Yes, and there's another thing I wanted to actually, it kind of ties into my previous answer, to be honest, is you should also, your business plan should be encompassing of the business, not the investor. You're not pitching to, you are pitching to raise capital, but you need to make sure that your business plan will accurately portray what will be going forward. Christian touched on this earlier, is you do not, the most embarrassing thing, any discrepancy in the data that you're presenting will come out during diligence. We will oftentimes know more than the industry about your sector and your industry than you do, and make sure that you do not present any false allegations, because he's right. That is not only a bad look internally, but it will ruin your reputation along the way. So make sure that you're not putting any falsified or padded data on your deck or your presentation, that will come and kind of expose you later just to impress the investors. Having a presentation that reflects who you are and who you can go become, that's what I think is honestly will kind of tarnish the name of the entrepreneur indefinitely, is if there are lies or discrepancies in kind of the accuracy aspect of the pitch.
Brilliant. I'm conscious of time, but I'm going to try and squeeze in two quick last ones in there. The first one really just builds on the back of what you were just saying there, Travis, about due diligence and the like. And as a result of the due diligence, it's likely that if an offer is going to be made, that it might significantly differ across different markets. So, for example, I'm sitting over here in Belgium. The term sheet that I'll actually receive in Belgium, it would be quite different to one that I might receive from a UK investor. So is there a general strategy then that somebody can actually stop and look at or try and develop to go forward? That's the first one. So either or to pick
I
it
mean, as an entrepreneur, you've got to be very mindful of those small clauses in those agreements. It is such a serious subject matter that I spend an entire segment on term sheets when we do our workshops. I've seen unfortunately, more than a few companies hit the wall because of draconian clauses in a shareholder agreement or an investment agreement. So I've been that guy. I'm now a new guy. So I tend to look out for those things, and certainly to all the entrepreneurs out there, when you're getting advice, be mindful of who you're getting the advice from. Make sure the solicitor, the individual lawyer, not the firm, is as au fait with shareholder agreements and investment agreements, so that you don't make those mistakes. Travis.
Yes, and this is only exactly what you said. This is only even more paramount when looking at debt term sheets from debt providers. Covenants are I don't know how deep along a lot of these the process some of these entrepreneurs are, but as you start getting growing as a company, oftentimes you'll leverage out some of these equity rounds. You'll be raising to prevent dilution, X, Y, and Z. Well, when you start doing that, be sure to read every term sheet you get 3 times over, and then send it to five different lawyers or attorneys that you all trust, and even make sure your board of directors are understanding of kind of what you're possessing, because the covenant options, i.e., what the debt providers can then act on once either their debt converts into equity, or as a duration, the principal of the loan, are quite extreme and quite draconian, as Christian said. Oftentimes, it can be limiting how much other capital you can bring in during the payoff period, X, Y, and Z. It can destroy your cash flow issues, all in the name of creating some sort of ROI from the investor. So yes, on the equity side, earlier stage, angel checks, absolutely read those term sheets very, very closely. And as you grow as a company, that becomes only more and more important. So yeah, please be careful. Oh wait, yeah, sorry. Back to the original question about kind of the locality of investors. Oftentimes, I don't think you should play that game, at least initially. I would say it's very rare that you should go and raise or at least earlier stage rounds abroad until you're post product. I would say again, it goes back to the IP issue. Oftentimes you'll be protected within your own borders or your own trading area if you are sticking with domestic checks initially. If I was a Belgian early stage company looking to raise in the US, I don't feel very protected, and I also feel I'll kind of get people look down. I would say you get more favorable valuations internally as well, and so that's what my recommendation would be.
Yeah. There's
Brilliant, thank you.
There's a number of questions on the chat that I've just opened up, which unfortunately we can't get to, but in that chat I've put Travis's email address, and I've also put mine. So I mean, certainly Elias is our main point of contact for any further questions, but speaking on behalf of Travis, I mean, we're here to help, right? That's our job. We're both in the UK for a reason. We think it's a great place to be. We think it's a great market for investments. And certainly we're here to answer questions for any entrepreneur and even any investor on our thoughts on technology investments in this new era.
Absolutely. Just to piggyback off that, thank you so much for having me. It's been really a pleasure, and I'm here to help for entrepreneurs, investors, or not. Don't know if I can help, but anything that I can answer, I will be more than happy to, and just always keen to talk to people that are trying to change the world. So again, would love to help however we can, both Christian and I, and are excited for every single person and their journeys respectively.
Brilliant. Thank you so much for both of your time here today. I know that we have gone ever so slightly over, and there are a couple more questions in there. We will pick them all up. But again, on behalf of the CIT, on behalf of the VCM team, thank you both super much, so much for helping out. And I was reading one of the questions there just there. Thank you so much for helping out and joining. As Christian did mention, we will be running a follow-up session in a couple of weeks. All of the questions we'll send over a follow-up to that. If anyone is interested in either joining that session or featuring in any one of the follow-up brochures that we send out, please feel free to reach out, reply to the message. We'll send all of the details so you can actually get in touch and really run from that. And just as the final word then, as my camera decides to turn itself off, the final word as we close off, is there anything that you'd like to leave as a key takeaway?
Reach out, get advice, because the world is constantly changing.
Absolutely. Back to Christian's first slide, entrepreneurs assume risk. That does not mean you tolerate risk. There's a difference between a gambler and an entrepreneur, and make sure that you're smart with your business plan, especially in the early stages. Christian and I are always here to help answer any of those that may come up. So cheers.
Brilliant. Thank you all so much. Thank you both for tuning in. Thank you all of the audience, and we'll be in touch.
Thank you. Take care.
Have a wonderful day.
Bye-bye.
Thank
Thanks.
Cheers.
Bye.